HIMS and HERS stock is down over 20% today after releasing their earnings report. They beat on both the earnings per share and revenue. However, they did miss on the margins and said they're going to be selling less weight loss drugs, which is why the stock is tanking today. HIMS and HERS is a telehealth company that provides a subscription for people to order products from. Even with the big sell-off, HIMS and HERS is up over 63% year to date due to the excitement from investors from their weight loss drug and increased sales from that drug. So today in this video, I'm going to see if this sell-off presents a good buying opportunity for HIMS and HERS stock. I'm also going to analyze the company using my 7-step stock analysis. And at the end of the video, I'm going to use my intrinsic value calculator to determine what value we should pay for the stock. The first metric that I'm going to look at for HIMS and HERS is the trailing PE ratio. I want the trailing PE ratio to be greater than 0. The trailing PE ratio is the price of the stock divided by the earnings per share. So if it is greater than 0, that means they must be profitable. And as we can see here with HIMS and HERS, they have a trailing PE ratio of 116.61. While this is very high and the average for the stock market is 20, this is a valuation metric, so that's probably not good for us to buy. However, we won't know for sure if it's too overvalued until we use our intrinsic value calculator. However, the PE ratio is a pretty good sign of valuation. Now I'm going to look at the forward PE ratio. I want this to be less than 30, showing that in the future the price of the stock is probably fairly valued. And as we can see here with HIMS and HERS, they have a forward PE ratio of 104.17. which is over triple the amount that we want. So this looks like it could be overvalued, and that is an X for HIMS and HERS. The next thing I'm going to look at is the revenue growth rate. I want the revenue growth rate of HIMS and HERS to be growing at a greater than 5%. And as we can see here, the lowest that HIMS and HERS revenue growth rate was 45%. So they are growing at about a 75% rate of their sales. So this is insanely fast growth. However, we do have to be careful if they can sustain this. But if they can sustain this, this looks very good to invest in if we can get it for the right price. So this is a check mark for the sales growth. Similar to the revenue growth of greater than 5%, I want the earnings per share to be greater than 5%, which is basically the net income divided by the shares outstanding. And as we can see here, this has been growing very nicely. They were negative EPS for a good amount of time until just recently. They have been growing insanely fast, and they have a positive EPS now, and they are now profitable, like we saw earlier with the PE ratio. So this is another check mark. This has been pretty much increasing every quarter since about 2020. So this is another check mark. Now I'd like to look at the shares outstanding. I want the company to be buying back shares, because if they increase their shares, that means there are more shares outstanding and more people can buy, and the less value one share is worth. So as we can see here, this is increasing, so this is not good. We want them to be buying back their shares so we are not getting diluted. However, as this is increasing, they're diluting us shareholders. Now I'm going to look at the total debt divided by the equity. I want this to be less than 100%, meaning that they have more equity than their debt. And as we can see here, they have an insanely low total debt to equity ratio, about a 2.38% total debt to equity ratio. This means they have about 50 times the amount of equity compared to their debt. And as we can see here, they have so much more cash than debt. They have $325 million in cash and only $11.35 million in debt. So this looks very, very unlikely for HIMS and HERS to go bankrupt or be in any sort of debt trouble. So this looks very good on the debt side of things for HIMS and HERS. The final metric that I'm going to look at before I use my intrinsic value calculator is the analyst expectations of earnings per share. While I could not find the EPS growth that analysts expect, I did pull up their recent earnings report right here from today, and they do show that their revenue is supposed to grow at about a 59% rate next year. So this is definitely a check mark, greater than 5%, so this looks very good for HIMS and HERS, especially on the growth side. Now the final thing that I'm going to do for HIMS and HERS is going to use an intrinsic value calculator to see what price I think we should pay for the stock. So I have to use assumptions for the next 10 years to determine what we should pay for it. And the first thing that I have to assume is the revenue growth rate. I'm going to put the revenue growth rate at about 20%. I think this is fairly reasonable, especially over the past 5 years. They've been growing at a 100% rate, and they were expected to grow at about a 50 to 60% rate over the next year. So I'm going to be more on the safe side and say they don't grow that much. If we go to a calculator and see how much revenue this would be in 10 years, I'll put 1.2, which means 20% growth rate. And then I'm going to put this to the power of 10 since that's how many years it will compound for. So this is 6.19. And since the revenue is about 2 billion right now, I'm going to multiply this by 2 billion. And as we can see here with my estimates of 20% revenue growth, that means in 10 years they'll have about $12 billion in revenue. And I think that's pretty reasonable for the company. Now I'm going to go back to the net profit margin. The net profit margin has been all over the place because they are just finally getting profitable. Just last year they had an 8% net profit margin. So I'm going to put this at about a 15% net profit margin. The reason I'm going to do higher than it has ever been is because in this recent earnings report, they did expect their net profit margin to be about 13%. So I think they can continue to grow this. And since it's a telehealth company, they do normally have higher net profit margins. So a 15% rate could actually be a little bit lower than what it will be. But we are going to keep it on the safe side to see the net profit margin. The cash conversion rate we can leave at 100%. And now for the terminal PE ratio. Since they're going to grow at a 20% rate, which is insanely fast, especially for the stock market, I'm going to put the terminal PE ratio at 25. Since it is a above average company terms of growth, I think they do deserve the higher premium. Finally, for the discount rate, I have been debating on what I should use for the discount rate. I think I'm going to put this to 15%. Normally I do 12%. However, I do want a higher margin of safety. And as we can see here with HIMS and HERS, I think the fair value price is basically what we are at right now. I think the fair value price for HIMS and HERS is about $40. And as of today, it's about at $40. If you think these assumptions are correct with the revenue growth and net profit margin and the PE ratio in the next 10 years, I think you'll get a 15% return on investment year over year with these assumptions. So thank you guys for watching this video. Please put in the comments what you want next. Please subscribe, help out the channel. I'm trying to get to 1,000 subscribers. And also hit the like button. See ya.